and I'll do.
Good.
Sorry, Ian, what did you say?
Well, I've just asking the question, how much will it cost to get us onto a sustainable development path worldwide? And if we take as a proxy for that, the cost of achieving the Paris Accord, in other words, keeping us to around 1.5%, 1.5 degrees C of global heating by mid-century, the estimates there are that it would take something like between 1 and 1.3% of global GDP, which doesn't sound like very much. It adds up over the over the years to something like $46 trillion, which sounds like a great deal of money. But when you look at some of the figures in the slides, and in particular at the amount of money which is spent on subsidies worldwide for unsustainable activities in relation to fossil fuels extraction and so on, then you're looking at much higher proportion of GDP, global GDP, maybe up to 6%. Now, interestingly, I did a back of the envelope calculation a few years ago when I was trying to work out how much money the OECD countries had spent on making the transition to an IT economy in the 1980s and early 1990s. Now, I've never seen this figure anywhere else, so I can't vouch for it, but it was my calculation. I reckon it was about 6% of GDP was being spent on upgrading IT infrastructures, which is roughly the amount we spend on unsustainable investments in fossil fuels and so on. So if you look at it that way, then reaching the Paris Accord target for allocation of capital, and if you look at similar costs for the SDGs, these look like bargains by comparison with the amount of money we're actually investing in unsustainability. Anyhow, that's the message that comes across in the slides. So what we need to do is reallocate capital on a massive scale from where it currently is. But there's no question we can afford it. The question is, how do we do it? What are the right vehicles that we should use? What are the markets that need to be established? What are the incentives? What are the barriers that we need to overcome? And one of the big areas of promise there is that we could invent new financial instruments, such as green bonds. And that could be a way of completely retooling the economy and getting the financial system aligned with sustainable development goals, which it currently isn't. Anyhow, that's enough from me for the moment. I'm sure you'll all have a lot to say about that, but it'd be great to hear from you, Lena, on all of your work.
You're muted.
Sorry. So you've actually touched on almost all of those points that I'll probably discuss and slightly go deeper into. So I'm going to start sharing my screen. There we go. So let's just move this on the side. Yeah. Can you all see my screen just to check? Okay, perfect. So sorry, just go back. So I'm at Climate Bonds Initiative. I started in 2018 while I was doing my MSc at University of Surrey. And so at the moment, I'm the Senior Communications and Media Officer. So I started CBI as a standards intern. I was working on my my dissertation on my MSc at that point, actually trying to find out pathways of trying to get low carbon cement going. So we'll get to those things. So I was at the University of Surrey doing corporate environmental management at the CES department, where Ian and Walter, they head that. And then before that, I have a background in BBA in marketing and finance from Pakistan, from Karachi, actually. So let's go into what this is. So the idea with CBI is that we take everything and build it around the Paris Agreement. So the goal of CBI is to achieve to tackle climate change, that is to make sure by half century we are below 2 degrees or up to 1.5 degree global temperature rise. Now, in this slide, if you look at this, the Paris Climate Agreement has been mapped out really well by this professor, actually, Jorge Vinuelas at University of Cambridge. So he's like defined the pathways. So there's two things you need to do. One is to mitigate emissions. And the other one is, as climate change, we are looking at minimum of, 1.5 to 2 degree rise. That will cause a lot of climate change catastrophes around the world. So how do we build an economy that is more adapted and resilient against climate change? So if you see here on this slide, finance under Article 9 of the Paris Climate Agreement is essential to facilitate and assist in this mitigation and adaptation goals of the Paris Climate Agreement. So without finance, it's impossible. So you do need government and policymakers to sit down and establish NDCs and things like that. But finance has to be around all of that. Finance has to be establishing its frameworks and providing the support and the direction and definitions and standards and all those things around all of that. So that's where Climate Bonds is like, okay, this is our mission to achieve Paris Climate Agreement and to do things around policy, around the financial market developments, around trying to get emerging markets and everyone on board with these things. So we go across different areas of the market and try to develop the capacity where financial markets can deliver the Paris goals. So then here we have where Ian mentioned, you have $90 trillion in global debt markets. So this is including the whole cake, this is the whole pie. 90 trillion in bonds, and of those bonds to date, as of here, if you look at the figure, 31st of December 2019, 733 billion were labeled green bonds. And our goal, which was one of the things that Christiana Figueres, I think it was the 2017, one of our conferences back in 2017, where she mentioned that we need at least $1 trillion in labeled green bonds by 2020, and then $1 trillion every year in green bonds by 2020. And the thing is, last year, we ended up with a figure of 258 billion per year. So last year's figure was the highest, but it's still way, way behind what we need, at least in green bonds. This is not to talk about the rest of the money that is needed towards mobilized towards climate change, but just to look at the global debt market and green bonds, we needed $1 trillion every year. So we didn't get, we only achieved a quarter of that. So there's still so much that needs to be done. And here you have 1.06 trillion in climate aligned bonds. So these are bonds climate aligned. So in the global debt market, you'll see a lot of jargon, and that's usual. That's a very obvious thing about financial markets, is there's a lot of financial jargon. So what in climate bonds we've defined as climate aligned are those corporations or organizations who are issuing bonds, but they're not labeling them as green. So they're not calling them a green bond, but if you actually look at the operations of that organization, they're essentially green. So somebody like, I guess I would say Tesla, for example, would come in a climate aligned, because if they're doing a lot of batteries and electric cars and vehicles, their essentially bonds are green. So we're supporting companies or support companies or invest in those companies which are actually doing a lot of green initiatives. So now we can break down, we can see the growth in green bonds market. You can see clearly there's been just constant, it's a constant exponential curve. we've been seeing, and this is the reason why there's so much interest now in the green bond market, is because of this curve. Because very rapidly, we've seen across these few couple of years, we've seen huge growth in the market. And because of this growth constantly, it's attracting a lot of people, a lot of investors. And when I talk about investors, that's one more thing to highlight, that Climate Bonds Initiative is investor focused. So what that essentially means is we want institutional investors, which are these very, very large pension funds, development banks. So we want all those kinds of funds, which are like, you know, for example, Japan's pension fund is the biggest pension fund in the world. So where do these people want to invest their money? Obviously, this money, and especially like we should also question our own pension funds. This is money for our future. So these investors are being very, very cautious of their stakeholders' money, where is it going to go into. And so they want to invest in a lot more green. And a lot more green investment is also this drive, or this demand in green is also being driven by policy, which has shifted quite heavily. For example, by the EU. EU's always had a very clear mandate towards environmental and green initiatives. So they have the EU, you know, environmental law has always been the basis of many developments for sustainability in the past few years. So they have mandated that a lot of investment has to be done towards green. So the investor demand has been the reason why the green bond market has been growing so exponentially. So what are the incentives? Well, for investors is the environment that they can say in their ESG portfolios, when they maintain that this is our ESG portfolio, that when we're investing in a green bond, it's showing the green in side of things. It's risk mitigation against you know, non-sustainable investments. So they don't want to, if they do have some of the portfolios which are towards non-green investments, this helps them, you know, make sure that the investment stays retains its value. And then there's a lot of reporting that goes into green bonds, which we'll touch on ahead. So that is a benefit for the investors. For issuers have reported that there's a lot of investor diversification, because they don't want to be dependent on a few investors, because that's quite risky. So they need to have a lot more investors investing in their portfolio. There's you know, capital protection characteristics and stock price correlation. These are a bit few technical things which probably we don't need to go into. So at the moment, you can see there's a lot of growth in the sovereign bonds area. Last year, we have, up to date, we have 12 sovereigns that have issued very large green bonds. Some of them have been issued very large green bonds. Last year, we saw quite a few coming to market. One of the biggest ones was the Netherlands bond for last year. That's the second largest bond to date, which is 6.6 billion euros. And that bond was heavily oversubscribed, which means is that they had so many investors coming to the books and trying to buy into that bond, into that investment, that they were you know, 3-4 times oversubscribed. And then that helps, because everyone wants your paper. Bond is a paper, you know, pledge that you give to to investors, that they will, you know, we're going to pay your principal and give you a yield as well. Because so heavily subscribed, there's so much investor demand that the issuer, for example, this sovereign, for example, the government of Netherlands, can actually tighten the yield. So actually, like, pay less money out in interest to the investor. And some cases, actually, we've seen negative yields. So like, you're not going to make money, you're going to lose money. But that is because a lot of investors have a mandate to invest. So they have to invest. They have the money, they have to put it in green. So things like that happen around the market, which makes the market so much more interesting. So you can see this is the mix here. If you could go back to the slide. So you have asset-backed securities, financial corporates, non-financial corporates, development banks, local banks, governments, sovereigns. So this is the mix of the different kinds of issuer types, if you say, and different types of instruments as well that have made the mix of 2019 and all the rest.
Lena, sorry, it's
yeah.
Ben. Just a quick question.
Sure.
Any idea why the loss of momentum in 2018 at all?
So I think there was not really a huge loss of momentum in 2018. It's just several things. I think there was an element of many issuers have, because the thing is, we go into the whole reason of use of proceeds and all of that. There's a lot of work that goes into coming up with different projects to map the proceeds to words. So there's reasons why, for example, there's a lot of issuance that is hampered by the kickstarting of those projects. And so if an issuer, if a lot of issuers cannot find the projects or do not find the incentive or public policy or things like that affect issuance. So the 2018, there was a slowing down effect of it, but we try to investigate why was this, but there's multiple variables around the reason why 2018 was slower than 2017. But then again, it's also this bit that you're seeing is only labeled green bonds under climate bonds initiatives methodologies or our definitions. So there is issuance which is not completely recorded here because there are those non-labeled green bonds or those green bonds that actually go under definitions for other recording agencies like Bloomberg or something would. So for example, our methodology says that 95% of the proceed has to be allocated to green. If it goes to 96, 93 or 94%, it's not recorded in our green database. So that is a bond that is not taken. So if, for example, the proceeds are more towards social side of things or, R&D, for example, expenses. Some of the proceeds are going towards more research and development. That bond will not be part of the label. So this is probably because of quite a few variables. But nonetheless, it has always, what's important here to note is just the fact that it has been increasing. So there could be a huge bulk here, which we don't record because that is just not under the definitions, or the fact that the markets saw different, around the world, different issues with economic growth or something, or policies or whatever.
Lena, could you just define what a green bond is? What's the criteria of or the regulation of a bond being green? If you could just summarize that.
All right. Yes. Okay. So now we come down to the basics of a green bond. So under our methodology and just generally when you say a labeled green bond, so there's a bunch of parameters across which you can call a bond a labeled green bond. One, for example, a very simple one. The CEO of the company says, I'm going to do a green bond. And he goes public, they do a formal media release and come to market and say, we're going to issue a green bond. Now that's it. That's basically it. That's what you call a green bond. But then there's all these other things where you say, okay, yeah, so they're coming into the market just saying, okay, one claim from the CEO, it's a green bond. And then investor can come in and check the credentials, and if they're satisfied it's a green bond, because every single investor has their own risk assessment due diligence profile that they follow. So if they say by their definition, by the investor it's green, they're satisfied it's green, fine. Then the other one, and so that's what we also do. So we say, okay, this bond is supposed to be green, let's go and see what's going on. So a green bond usually follows the use of proceeds model. So when you raise a bond in the market, those funds that you're raising we call them proceeds. Those proceeds have to be mapped to individual projects or assets or activities. So if you can see here, this is like sort of a, you can see all the different kinds of activities at the moment that you can fund, which are essentially green and have, or have criteria for green, which is definitions around which you could, okay, this is how we can do a green bond following this metric and blah, 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 blah. So you have to identify projects and assets and areas of activities which you will put the proceeds towards and map the proceeds on them by creating separate accounts in your organization, financial accounts, by earmarking the money. Sometimes, you know, that's actually even better. We encourage that heavily in our definitions, that you earmark literally, like every dollar that comes in has a stamp on it saying this goes straight to that green project. So the use of proceeds model is a model that has some criticism, but essentially it's one of the better models, because you can have organizations that are essentially non-green organizations, but then they can start doing green projects as well. Because at the end of the day, it's not really it's not really about who is doing it, though it is. The reputation of the issuer matters heavily in the market in terms of who will want to invest in that firm or not. But it's also at the same time, if you actually look at on a practical sustainability mindset of things, we want everyone to be doing green things, to be doing green activities and operations. So that use of proceeds model gives an opportunity to every single player in the market to come in and do something green. So the use of proceeds model so we have established with Climate Bonds Initiative was one of the first, and then before that we had the Green Bond Principles. So the Green Bond Principles are just voluntary principles that are built around the use of proceeds model. The use of proceeds model came from the Green Bonds Principle. And so they actually are voluntary principles that any organization can adhere to, that can allow them to say that, yes, we are adopting the Green Bond Principles and we will issue a green bond according to the Green Bond Principles. Now, Climate Bonds Initiative, we developed a framework around the Green Bond Principles, and we've developed this we call it our Climate Bond Standard and Certification. So that is slightly a par above. It is sort of like the most, how many people call it, like the gold standard of investing or labeling in the green bond market. So it's got, we will get into that ahead. So it's one of those ways where you can issue a green bond. So what is essentially a green bond? It's a bit of it's a fixed income instrument, and it comes to the market in financial markets, and fixed income financial markets, or capital markets we call them. And it's a bit of paper that has a coupon rate on it, which is going to be the yield. So it's like if it says 3%, 4%, that is the percentage of growth you'll see in the value that the issuer, the person who is offering you the bond, is going to pay you out with your principal that you've invested in there. So that's essentially a green bond. There's no difference between a green bond and a vanilla bond. Vanilla is like just any other bond. So a labeled green bond and a vanilla bond are essentially the same thing. There's no difference. But with green, yes.
Can I pull you back a bit to criteria?
Yes.
About what makes a green bond a green bond. Have you ever come across situations where green bonds have a conflict of interest? And what I mean by that is, I was listening to a webinar last week where green bonds were coming out of the World Bank purely for the construction industry to build green buildings.
Yes.
But what they were talking about, in a way, has conflict with biodiversity and the more holistic impact of those green buildings. So if I've got a green bond that focuses on biodiversity, there could be a conflict of interest. Have you ever come across anything like that? Does that happen in the market? How is that overcome?
So that's the thing. So we have mapped several sectors. So when you talk about this criteria for green in terms of buildings or transport or any of those issues, you are talking about the actual asset itself, the capital asset itself. So if it's a building, it's just the building. So the criteria, the scientific criteria that determines is the metric of emissions or equivalent emissions of CO2 that is going to be mitigated by, at this level, for example, 100 grams of CO2 equivalent per square meter could be one of the metrics for yes.
In this case, they were looking at energy savings of 20% and water savings of 20%.
Yeah.
And the other criteria was the materials used. So
basically, so this is the thing. So they could have any of these metrics, right? Now, if you look at how the investor community tackles with this, when we establish criteria when the money goes towards one particular asset. Now, the investor community will investigate when they put their money in that project, and they're a green investor. If they are an investor that comes to market labeling themselves as green, which most of the investors do, they would actually check and see if the other credentials adhere to it as well, just like you said. So if there's huge reputation, there's this huge publicity around, there's a lot of risk of biodiversity or loss of green area, green belt area, or any of these other things, if they are publicized heavily, no green investor would want to invest in that. So for example, there was a green bond that was supposed to come by Adani, one of the biggest coal producing, their organization, which their project was heavily green, almost purely green. But Climate Bonds Initiative did not grant certification for that because the board, which is an independent party, the board said, no, this organization, even though the project is completely green, the use of proceeds will go to complete green projects. We do not support them because it seems like this organization doesn't have a clear green transition strategy in place. So they will continue, it seems like from their practices, they're going to continue investing in brown for an indefinite time period ahead. So they did not want to certify their green bond because we don't want to support a company like that. And that's what happens more or less everywhere. So because financial markets, they seem to look like they rely a lot on numbers and things like that, but there's also a lot of subjective judgment involved, qualitative judgment from the investor community, from different organizations such as, verifiers who provide second-party opinions. So for example, you have Sustainalytics, which is one of the biggest green second-party opinion providers. So even they would not, because they're looked at as Sustainalytics, for example, is looked at as a very green verifier or verification service provider, second-party opinion provider, they will not want to put their name or their reputation on risk for a very non-green issuer, or they're doing something labeling it green, because there's a lot of scrutiny that goes into it, and there's a lot of reporting that has to come by. So so these type of things, if the magnitude of the biodiversity loss or something is quite heavy, it will not essentially be green. That will come out in the market and nobody would want to invest in that. So I can go back to, let's move on to, so is there everyone, have you got any other questions around the basics of green bonds? Okay, so green bond, yes.
I was just going to ask a question about, obviously, it's overall the bonds that you've shown, it's quite small in terms of the proportion of the market, and also quite a lot of the breakdown of the bonds are sovereign backed or partially sovereign backed in the sense that they're so in that way, how much of the market is seen as a good option for diversification because they're very safe bonds versus how much is it growing as an overall market? Does that make sense? I don't know anything about bond markets. This might be a very ignorant question.
No, but it's a very it's actually you're completely on the money. You're completely right because diversification is one of the problems of the market. We need more diversification. We need more instruments that need to come out into the market because that is how you can get larger investors coming in. Because there are not many, for example, institutional investors, they need to invest in fixed income and things like that. So we've recently seen, like if you see the curve here, we've gone back into a lot of green loans are coming to the market. So if you see here, they were almost non-existent in 2016. They weren't there at all. 2017, you saw some. And 2018 more, and then 2019 we had quite, I think, like 10 billion or something. So green loans are one of the things where we can activate quite a few of the banking industry coming towards greener things. So yeah, we need a lot of instrument diversification, and in emerging markets we've seen there's a huge problem of attracting a lot of investor because of the lack of trust. If you're investing in Nigeria or you're investing in India or places like that. But then you do have organizations such as Garenco. So Garenco is an organization which guarantees that this bond will be paid out to the investors in full and the promised coupon. So you have a lot of organizations like that who actually go into very risky emerging markets, and they provide them the support, these organizations, these issuers, they provide. So for example, Pakistan, it's a very risky, buying any bond from Pakistan is a very risky thing to do for any investor. But obviously the returns from those markets are going to be heavy because of the risk. So you have organizations such as Garenco coming in, and they will be like, okay, we're going to insure your bond in terms of like if you default or whatever. But then those guys go in and they actually help those projects to get delivered, and the risk and to be mitigated, and the return to be provided back to the investors, up in Europe or somewhere. So we've seen also like the Chilean sovereign bond was something that was heavily 18.6 times, I think, oversubscribed. That was like a crazy amount. I think we've not seen any bond that oversubscribed in terms of green. So even though Chile, that was the first green bond out of sovereign green bond out of Latin America, and then it was the first green bond out of Chile. Then they came to the market. I think they tapped 4 or 5 times in less than 6 months. I think in 3 months they tapped the markets 4 or 5 times. So green bonds are also a very good way of helping emerging markets deal with their nationally determined contributions, which is, and especially we know a lot of these countries will be affected heavily by climate change. So this is sort of like the best way they can use this instrument towards doing projects that actually builds resilience and mitigates climate change risks in those markets.
Lena, are there tax incentives for green bonds to attract investors in?
Yes, in America, for example, the municipals that issue green bonds actually don't have to pay any tax. So green munis in America, they are tax-free, which was one of the reasons why we in climate bonds, we coined a term, we call it greenium, which is heavily contested. There was actually a paper questioning this, and maybe I guess I can invite you guys to go and see that paper. I might leave the link later on in this presentation, by Stanford. I think it was published by Stanford, and it was done by the corporate law school Harvard Law School. So anyhow, they because of the fact that there was no tax, that these munis achieved less, less cost at, and then they could tighten the curves and everything. So again, that's something I would go into. But yeah, they do get tax incentives. They do get policy is backing them heavily, especially in Europe as well. There's quite a bit of subsidy and tax benefit in terms of that, but there is obviously subsidies in the fossil and brown industries as well, which is kind of like an issue, I think, with our sector. That's it. So so the green bond pricing, this is one of the areas which is very, very interesting. We have done research since end of 2016 and then periodically till now. So pricing is, so when we're looking at pricing, we're looking at the perspective of the issuer when an organization comes to raise a bond in the market. So this is the reference point. So what they've realized that quite a few first-time issuers, when they come to the market, they've reported, they say that they've been able to achieve, because of the fact that there's such high demand and very little product out there. So there's the bonds that are out there are very few. There are not many. You don't get that many green bonds, and you don't get that many quality green bonds. By quality, as in the reporting lines are very clear. There's a lot of disclosure. There's a lot of reporting and third party and second party opinion, things like that. So that's very few. Those bonds are very few in the market. So when so a lot of issuers are reporting that either their bonds are priced at the same level as, for example, exactly the same kind of bond, the same sector, the same industry, the same type of issuer, which has the same, reputation or whatever. When they come to the market, their non-vanilla equivalents or the green equivalents have the same coupon rate. So this whole idea of like, oh, green bonds they're not profitable, that is not true. They have this exactly same profile of profits or yields or coupon rates as any other non-green. And sometimes if because of the fact that there's so much investor demand, that issuers have been able to tighten their curve, which we call the 20% greenium, which is we've noticed that over the years 20% of the issuers actually experienced greenium, which is, for example, in the case of the Netherlands bond or the Chilean bond, which everyone was a sovereign. So obviously that's a very attractive bond to invest in. And they had 18 times oversubscription or 3 to 4 times oversubscription. Obviously that means there's so many people out there, they can actually offer less coupon rate and then sell their bonds to anyone who's willing to offer, who's already registered themselves on the books. And then we've also seen that when these bonds are sold back into the secondary market, they tend to also tighten more. So there's spread. Spread is something, for example, you have bond A and bond B exactly alike. They're exactly the same bonds, but their prices are different. So the difference between one bond A and bond B's price is called the spread. So meaning this bond is better than the other one in terms of the value that you're getting, because you're getting more money out of this one and then less out of that one. So that's just a spread. And what the halo effect is in the stock market is called is because you have an organization issuing green bonds, people think that their organization is greener. So that makes the organization look better, because that makes the organization look more sustainable, that these people are actually taking green initiatives. And so it improves the reputation. So issuing of green bonds actually has a halo effect for that organization in the stock market as well. So even though you're issuing bonds, you also get in the equity markets, the share markets, you get that idea like, oh, okay, this organization is more sustainable, it's more green. That kind of effect has sort of like gone across, and there's actually evidence for that. We've done research on these things. So current developments, we have these are the things that mostly Climate Bonds Initiative is sort of involved in most of the time. So we're involved in voluntary rules. So we try to go across the world and try to uplift the adoption of these rules. So green bond principles, for example, the climate bond certification, and also try to improve regulatory involvement and regulatory guidance. So our, my CEO and the rest of our organization has quite a few people who talk to different markets in terms of every level, at the government level, the sub-government level, to across the board, the agencies, the development banks, the supranationals, to try to instill these voluntary or try to uplift them or have them adopt these. Product extension, yes, we go and we talk to, we do speak to quite a few organizations on the investor side of things and on the issuer side of things, where we try to to promote with the underwriters and everything more products. So you have the green loans, we have the green shoe shine, we have the transition bonds, several other retail products that you can green mortgages. Barclays Bank did a green mortgage, which was quite a nice initiative. I think it was also certified by Climate Bonds when they did issue that. And then also regulatory supervision. We talk to a lot of regulators and EU, and where we're trying to, the Bank of England and everyone, where you need to make sure that there's more green, there's more shift towards adoption of green everywhere. So have you guys probably have heard about the EU Green Deal? So this is an area of work that CBI has been heavily involved in. The EU Green Deal is essentially the EU's plan for the future of sustainably, to develop a sustainable economy, basically. So the EU's Action Plan on Sustainable Finance, formerly called, has resulted now. So our CEO, Sean Kidney, he was part of the high-level expert group, which was initially established by the Sustainable Finance Action Plan. And then later on, they developed that group. That group was very big, and it was condensed into a technical expert group, which is called the EU TEG. So they came up with these recommendations. Now, the EU Green Deal, as it's called, is made up of a few core documents or core areas. One is the EU taxonomy. And then the other one is the EU Green Bond Standard. The EU taxonomy essentially is a procurement list. So it's a list of activities, of assets or projects that are considered green. And then the thing is that this list is going to be in continuous development. The initial list has been disclosed and it's come to market. It came to market last year, and then it was in public consultation, and now they've issued their final report, I think in March. So what is the EU taxonomy framework? So they have this, they have the EU directives, the EU law, environmental law, which actually has the do no significant harm feature in there. And then, so what they've done is they've taken that and built on it. So the EU the activity or the project has to have these three, how you call them, safeguards, or these three features. So one is that it should at least substantially contribute to one of the environmental objectives of the EU, European Commission's environmental objectives. 2+, so it should not do any significant harm to any of the other objectives defined. And 3, that there's some minimum safeguards that should be there. So for example, it's an activity but that activity might have a bit of, you know, for example, cobalt drilling and acquisition in the Congo or somewhere. So that activity automatically has a lot of issues around causing civil warfare and slavery and things like that. So it should be clean of those things. So that's sort of like the sort of framework that it has to have. So when, for example, the investor looks at that investment, the investor has to make sure that, you know, these things are in place. So reporting around these things, or giving out statements, or making sure that their activities are not, you know, are following these rules. Now around that is the criteria. So you have different sectors in the economy, and all those different sectors in the economy have different science-based criteria, which is, you know, for example, always talked about certain 100 grams of whatever CO2 equivalent per meter square, or emissions in certain other metric that whatever the sector has, and that those sectors have different criteria that they follow. So those criteria have to be followed. And then there's the EU Green Bond Standard, which is basically, if Walter talked about the ISO standard, it's just like that. It's a standard. It's a guidance framework that the issuer has to follow step by step and report on all of those things, and has to follow that. So if they follow all of that, and you have a verifier who comes and verifies that, okay, this is following the entire EU Green Bond Standard, and then this is following the science-based criteria, emissions, metrics, whatever. And also at the same time, it doesn't seem to contribute substantially to, it contributes substantially to this, doesn't do any significant harm, and is complied with minimum standards, then that investment under the EU law or the EU taxonomy will be essentially green. So this is the whole, you know, plethora of things that they do, and that's going around in the green finance space to make sure activities are green, to avoid the greenwashing element, to make sure that what we're doing is essentially sustainable, according to the research that is available right now, according to all those things. Now, the EU framework is, this whole framework that they've established is essentially built around so let's just see. So it's essentially built around the fact that, you know, there's different sectors that they have to mitigate. So, and then there's different sectors that are already low carbon. So you have to make sure that they have to put the emissions down. They have to create pathways for brown industries, or slightly brown or less green industries, to move towards a transition, to allow them to move towards a transition towards green. And then later on, they would try to tackle, the EU taxonomy has still not tackled the SDG side of things. What all the activities under the EU taxonomy are essentially more like based on emissions reduction. And obviously some of the social stuff, which is the minimum safeguards and do no significant harm feature. And like you said, the question you asked about the biodiversity loss and all those things. So those things already come under this framework. But they are looking into going towards incorporating the SDGs and the social side of things, which are mapped out in the SDGs, and developing more criteria, or developing.
Lisa?
Yes.
Sorry, I'm getting quite confused at the moment, and it may just be me. When you're talking about they in this context, is it a bit of a double-edged sword? The people that are trying to raise the money by having a green bond, they need to fit with this criteria, and then the investors who want to invest in projects that are good for climate change and sustainability are equally looking for this criteria to be met.
Mm-hmm.
Is that am I understanding that right? This is sort of a common standard, and both sides and both parties need to meet this.
Yes. So when I say they, they is the EU, the European Union, that have assigned this Sustainable Finance Action Plan, or group that actually are going into defining and creating the definitions, where CBI is involved. So we're creating the definitions and the framework. Right now, the EU taxonomy is not being adopted or in practice. It has just come to market. We do not have a EU green bond standard as to date. It will be, there's questions about when it's going to come to market, but there was speculation that it will come to market by the last quarter of this year, but then I think it's moved to next first quarter, or in the middle of the summer next year, so sometime around then. So when I say they, we're talking about the bodies, the agencies, the independent groups, or the governments that are developing these definitions, which is essential for growth of this market. Yes, when we define these criteria and these definitions and build a standard that everyone has to follow, making it very easy. So this is the standard, this is the definition. You are an issuer, you're an organization who needs the money to do a project, and they want to come and raise the money. They will have to follow these definitions and the standard and the criteria. And then the investor, who is very keen, who's a very smart cookie, actually. The investors are very, very savvy. They're very, very difficult. They're very keen on, yeah, okay, I'm going to give you my money. How am I to know this money is going to go towards green? And then the issuer is like, yeah, okay, so I have a green bond framework. Look at my green bond framework. My CEO says it's green. We have made a green bond framework. That green bond framework actually has, has been verified by Cicero, and who's a second party opinion, or Sustainalytics, who's a second party opinion provider. And they're saying my green bond framework is green, is fine. And they have seen that we have created accounts inside our organization, and we have allotted all the money that will be coming out. For example, we need 500 million, which is what we call normally a benchmark bond. That's like the minimum, sort of like, not the minimum, but you call like an optimum level bond. So because when you're attracting really big investors, which are pension funds and everything, you need to come up with a huge size. So 500 million. So I'm going to raise 500 million for this project, and all of that 500 million has to be mapped onto what things that they have to go to.
So for the CBI, are you operating within this industry to try and give governance and to try and give well thought out frameworks that then provide transparency, and that you can work with organisations to validate that the framework that they've created is green, and that you can then put them in touch with investors? Are you acting as sort of like a little bit of an introductory type platform?
Yes, so we call ourselves as market developers. So we are working towards, let me just show you what the framework we have. Here we are. So the EU taxonomy is actually built around the climate bonds taxonomy. So we have initially, Climate Bonds Initiative, when we started off with creating definitions around different criteria. So these are all science-based definitions. The purple indicates that there is at the moment certification available. So there is criteria around public-private transport, public transport, freight, water treatment, water storage, flood defense, all these things we have criteria, definitions for. If somebody wants to come and issue a bond in flood defense, we can certify that bond and say yes, and follow, they have to follow our, our standard. So what is our standard? Which is, it's something that is it's a standard which is completely aligned with the green bond principles and green loan principles. We call it as the best practice for internal controls, tracking, reporting, and verification. And it's financing assets that are completely aligned based on our criteria, they're completely aligned with the Paris goals. So when I say, sorry, so when I say when the question you were asking, so when an issuer comes to the market, this is where if they're following Climate Bonds Initiative's standard, so Climate Bond Standard, they have to first come to market. They have to identify all their projects and assets that are going to be funded by this. So first you have to map out assets and projects. Then you have to make sure that these assets and projects are following the science-based criteria that we have. Then you have to create a green bond framework. That green bond framework has to be created, and there's support if you want to engage the verifier. They can help you create the green bond framework, but mostly issuers do it by themselves, or they hire somebody to do that. Then they engage a verifier. Now, a verifier is a third-party opinion provider, somebody like EY, Deloitte, all these people. Now, these people who we call a verifier, or within Climate Bonds, we call them approved verifiers. These verifiers have been checked by Climate Bonds Initiative. They have been trained by Climate Bonds Initiative on a regular basis. They have been briefed about the sector criteria. They have been briefed about the standard and the rules of the standard and the guidance of the standard. They have to follow the standard bit by bit, like line by line, all of that. And they have to make sure that, and then these verifiers, because they're such huge global companies, they have their name associated. So when they're supposed to come in and they're the third party who are independent, they come in and they say, yes, this bond by this particular issuer somewhere is actually adhering to your standard and is actually following your sector criteria. And if it's following those two things, then it goes from there into, so they create a pre-issuance report. And the pre-issuance report goes to the Climate Bonds board, the standard board. So Climate Bonds Standard Board, CBSB, which is again an independent board that sit outside the governance of the Climate Bonds Initiative Climate Bonds Initiative standard or any of that. So the Climate Bonds Secretariat takes this pre-issuance report from the verifier and goes up to the board and has a meeting with the board and presents the board with all of this about the bond, the organization, the reports, the disclosures, the framework, everything. Then the board sits down and assesses them and deliberates if it's certified or not certified. So once they get the certification, this is the certification label in purple with the tick. So once they get the certification label, we issue it to them. Then they go and they can actually issue the bond in the market and start marketing the bond as a certified climate bond. And once they start marketing the bond, they would start getting people buying the bond and everything. Now, then there's this, so once this is not done yet. So once they've done this, they have 2 years to have their funds that they've raised from the markets to have them mapped onto accounts that are supposed to go. So then we follow the post-reporting, the post-issuance reporting. So within 24 months, they have to make sure that the funds are mapped onto those accounts and the projects. And then they have to report every year for the lifetime of the entire bond, which is called the tenure of the bond. So they have to report every year on how the proceeds are being used for the bond. So this framework makes it very, very tight. Climate Bonds Initiative certification is sort of like the strictest certification or the strictest standard. The EU taxonomy or the EU Green Bond Standard will not be as strict as the Climate Bond Standard. We're stricter. And that is on purpose. We've made it more stringent for, this is our new standard this has been, so we have our standard version 3 now in market, which is actually far more stringent because we've actually included impact reporting in there and a couple of other things. Those details I won't go into. So we're more stringent.
Okay, I'm getting slightly nervous about timing here.
Okay, sorry.
It really is interesting.
Yeah.
I also don't know how many more slides you have.
I'm done. So I'm just going to talk about transition.
Is it possible to email me PowerPoint either as a PDF or as a PowerPoint file so that I can share it with the class on Surrey Learn?
Yes, definitely. I was already
Excellent.
thinking of that. Perfect.
Excellent. That's wonderful.
Perfect. Yes.
I would like to open the floor to questions. In the chat facility, you already see that we've had lots of questions about this around, and I think as a context, one of the really interesting things that currently happening with COVID-19 is that there's a lot of discussions that any money to finance the transition post-COVID should come with strings. So there are substantial discussions in the German industry that suggest that they shouldn't prop up companies that are heavily involved with climate change damages. There are similar discussions of this in France. Denmark has said they will not give money to companies that are not registered in Denmark. So, if they don't pay taxes, then they shouldn't have this. And I can see a similar lending opportunities with strings attached that the green bonds are coming around. So I think your contribution to the class, but also to the agenda, couldn't come at a better time. Any questions, any issues, any comments from the group?
Walter, one question is, the funds that are investing in these green bonds, and I'm aware of a lot of investment funds that now only invest in ethical and green bonds. But what is the real incentive for them? Is it a differentiator for the companies and the pension schemes that are in those bonds and the individuals, or are there any other tax benefits or other things that maybe we're not aware of?
So the thing is, there's mandates that have been placed by the investing organization that they have to, for example, they have huge sides of their business that are just green investors. So, for example, you might have Aviva, which has, or for example, you have, BNP Paribas asset management. So they have a huge section, and they're only supposed to invest in green. So that mandates them to be like, if for example, there's a guy and he's supposed to only buy green bonds, and if he doesn't, he will be fired because he didn't get a lot of investment done in green. So there's that side of things, that they have to be investing in green, and there's a lot of incentive on building the market as well, so that there's diversity of product out there. The thing is, investors don't really, this is how, from sitting outside, you might think, oh, profit is at the heart of things, but that's not true. When you're actually in the market, investors have come out and spoken publicly saying that we don't care that much about the yield or losing a few basis points on yield. We just need more green out there. And so they need to invest in green, and they need to build the market. They need to, their focus is that impact, making an impact in the market is their main focus. They want to make sure that if their money is being put somewhere, their funds are going somewhere, that they're creating a positive impact, not just ruining the biodiversity or the environment, or making unsustainable investments. They don't want to do that, and this is because of markets that have reached maturity, such as markets as the EU, which actually are driving this green wave around the world. So that's why the EU taxonomy is one of the things that we're heavily involved in, is because what they're doing is going to be a model that will be mapped around the world, and the Chinese market is also adopting this very quickly. So and that's sort of like a political shift. If you have the EU and you have China coming together as a bloc, creating this EU taxonomy, Chinese taxonomy around the world. That kind of gives you a procurement list of like shifting the whole vision. And we've already seen it with COVID crisis that these are not sustainable things to do. The economy right now is completely shut down altogether. That should not have happened, but it has. And so these type of non-resilient operations are done for. We need to move towards economies that are more sustainable. And so the governments recognize this, the investor community recognize this, and they see it as a huge risk. And so the risk mitigating of that risk, especially like you have the task force for climate disclosures, which is going to be, for example, the principles of responsible investing, PRI, will very soon make that mandatory for organizations to have TCFD incorporated into their balance sheets. So they have to show on their balance sheets how much of their portfolio, how much of the balance sheet is green and non-green, or if not, what are those activities where if the money is just sitting, not doing anything. So those kind of task force disclosure requirements would actually help the investor community understand on which businesses are more sustainable or not. It's the risk element that they see this as non-sustainable and they need to shift. That's the persuasion.
Can I ask Lena? Lena, sorry, I'm curious. I mean, the green bond market has been, it's been documented that it's going to grow very rapidly. But from the point of view of the questions around tax incentives, when you look at, I was advising on green funds back in the late 80s when I was an IFA within pension funds. We've got EIS schemes in the UK that attract great tax incentives. So my question really is around, how money can be attracted into a bond if a bond isn't going to perform as well as or offer the same tax incentives or better. I mean, there are obviously questions aside of the fact of governance, because certainly when I was advising, there was very little governance around what is green, what are we investing in. It's a highly complex subject, and my impression was that green bonds were more directed at the bigger commercial market as opposed to individuals.
Yes, that's true. Yep. Yeah, that's true. So green bonds are more, because the size is so big. Like you're talking about, when we say benchmark, we talk about 500 million, and when we say $1 billion, that is a good enough bond, but we need to see, in billions, we need to see 3-4 billion, and that's a substantial bond. So when we say that this is attracting institutional investors, this is attracting really big pools of money, trillions.
Sorry, again, the World Bank, the IFC webinar I was involved in last week was talking about, a 72 trillion green bond opportunity within the construction industry, and that really is surely institutional investors.
Yes,
I'm trying to give a better clarity to everyone, because some of the questions have been around tax incentives, and we need to differentiate between institutional investors and individuals.
Exactly.
There are different differences.
100%. Thank you for that, because that's the thing. We're not talking about me and you investing. We're talking about me and you, our pensions that are coming into a huge pool, and that pool being invested somewhere. And that's what we're talking about. And those yields, the thing is, because it's something, when you look at also green bonds, you look at especially green bonds have very large tenures. We had, I think it was Société du Grand Paris or SNCF Réseau, I think one of them issued 100, I think it was SGP. So they issued 100-year tenured green bond. Now that was something which was, many investors came to the market, they're like, even I will be dead by the time as a portfolio manager. Like, what does this mean? But it's just to signal to the market that we're not looking at the short term. we are looking at sustainable development, which is always the long term. So these type of things are where, you know, even examples are being set in the market, signals are being made. You know, they're like sort of telling the market, we need to start thinking about the future. And these are, most of the time, green bonds come out of big infrastructure issuers. So they're like, for example, SGP, like they're a huge railway infrastructure company. So they're building rail lines and everything. And the lifetime of those is very, very long. So they need to look at things like that, development that is sustainable, and how they see the world to grow into, which you probably have if you've been you know, in classes with Ian and Walter. They talk about the fact that we need to have transport systems, we need to have buildings, the built environment, the infrastructure, everything has to be time-proofed and climate resilient and everything. So these organizations are very much actively issuing bonds. Tax incentives, yes, because it depends now in what kind of a country you're living in. There is, for example, like I said, in America, municipals get a tax incentive. I'm not sure about other parts of the world. I definitely know about American munis. But the thing is that we, for example, at Climate Bonds, we work with governments and we work with policymakers, we work with treasuries, we work with other agencies who are responsible for policy and regulation and regulators and all. So we work with them to make sure that they are driving it as well. So with the Bank of England, for example, so the Network for Greening Finance and Sustainability, NG4S, they are a network of central banks. I don't remember the exact number of central banks. I think they're like, don't quote me on the number because I'm really bad at remembering numbers, but they're like in tens, like over 30 or something banks, central banks around the world who are part of this network, and their persuasion is to make sure that they make the shift for the economies towards green. So they are, yeah.
Sorry, can I ask you just a slightly different tact? I mean, you're looking at governance of green bonds and making sure that criteria benchmarking is achieved. Mm-hmm. Do you do any work on the flip side where, for example, a recent report I read on biodiversity was talking about the amount of money we're putting in to protect biodiversity or maintain it relative to the amount that we're spending on damaging it. So as much as we're talking about putting money into what is good, do you work on the side of, hey guys, you're doing the wrong thing here?
Yeah, so I think you're touching on the point of the brown taxonomy or the non-green activities. At Climate Bonds Initiative.
I'm sorry, I'm going back to something I think in John Elkington's book where he talks about the black swans.
Yes,
yes. You know, we're spending a lot of money on the black side and not the green side, but
yes, and there's actually a paper that we did recently on the green swan. There's actually a blog that we did. One of our teammates, he wrote that. But yeah, the thing is with Climate Bonds Initiative, we would love to, if we had the money as an organization. We're an NGO, we're very, very low on funds and everything. So if we had the capacity, if we had the funds, we would go out and research all these areas. We try to focus on the positive and the forward-looking things. I think there's so much work right now that needs to be done into the green side of things that we need to, if we have other organizations like, I think Carbon Tracker Initiative are doing something around that, where they're trying to map out the non-green activities. There are organizations that are mapping on the non-green side of things. But at Climate Bonds Initiative, we're focused on that bit where we are doing a paper on the brown to green transition. We're working with Credit Suisse on that. So that's going to be a very high profile, very, very good piece of writing. But essentially, brown to green will actually help identify those sectors, those players who are involved in, for good or for worse, but that is just how it is. That's how the economy is right now. There's a lot of non-green activities, but that's essential right now at the moment, the way the economy is. We need to make sure, there's a lot of talk about the just transition, which is trying to talk about the areas of the economy that are not left behind because of the as a result of the green transition, because that is also not, sustainability doesn't dictate that. You make sure that everyone has to make the shift towards green and create the least bit of social impacts and everything. So for example, we all just say, let's just abandon all the brown activities or the less green activities and then move on. That's not sustainable, because you've actually affected you've made a lot of social impacts that way. So there is this whole talk about how do we achieve the just transition and how do we make these leaps towards the greener side of things. So we're going to move, we have this paper coming up, and hopefully you guys will be able to read it soon after June or something. Yeah.
It's a really important point about the just transition, because if you look at the figures that are spent on subsidy for fossil fuel sector, the latest figures I could find was that it was something like, if you added in all of the costs of the negative externalities, typically climate risks, but also including air pollution and so on, then you get to 6.5% of global GDP, which is a colossal figure. So you might think automatically, well, what we need to do is immediately abandon all of those subsidies and just push all the money into green investment. But it isn't so easy, as Lena has pointed out. A lot of those subsidies are going to quite corrupt sources, and it's partly about people getting rich and holding on to their assets. But some of it is there because people are subsidizing what they regard as essential national industries and essential national employment. So we need to find ways of easing the transition before we think about abolishing some of these subsidies.
Exactly. And then there's also all these industries that are heavily dependent on a few fossil, at the moment, they're still like the steel industry, like the cement industry. They're still heavily dependent, and they do not have, so there's these multifaceted approaches that we need to tackle on all fronts. For example, we need to increase the technological advancements in these industries. The capital, the capex on these, so the capital expenditure on these is so high that they haven't, and the lifetime of these plants is so long that there's still going to be quite a few plants that will, unless the government buys them out, that's not that's taxpayer money, we can't do that. So things like that. So there's so many considerations that need to be made, because steel and cement are the fundamental foundations of sustainable development. If you want sustainable infrastructure, you would have steel in there, you will have cement in there. If you want rail transport, you will have those materials going in there, and they are very heavily polluting industries. So there's these questions that need to be answered. How do we achieve this? There's this massive amount of work that needs to be done into coming up with pathways and tackling all of those things. One of the problems was this, the COVID pandemic. Nobody in the EU taxonomy framework or the climate bonds framework or any kind of framework has taken or internalized pandemics. So our current structures, even that though we think they're the state of the art kind of structures, they have not accounted for them, because pandemics don't happen that often. And because of the fact that they're not so recurring, every single resilience piece of criteria or work that you go ahead and you look at as definitions around typhoon and hurricane and flood defense and all these kind of higher temperature droughts and all those things, and nobody's taken pandemics in any of those. They even have some other social measures, but nobody's mapped those. So now you have like COVID bonds coming in, and COVID bonds have they've most of them are not even like, there's no second party, third party opinion, but they're just like, because there's not much criteria from this or that to call it, but except say, oh yeah, this is going to be adding to the project is going to add to the social side of things or whatever. But what I mean is, like, we need to have those definitions, because we need a lot of work to be done in the definition, standard building, that kind of stuff. So, but it's just, yeah, organizations like ours and you know, several other organizations. They need to work very quickly, and governments need to support this to map out things and create standards and definitions.
It's interesting, isn't it, about the the way in which organizations, institutions, and governments perceive risk.
Mm-hmm.
In fact, they're just as bad as individuals at assessing it. The pandemic, even though it's come as a huge shock to lots of us, it's been forecast in all kinds of reports. And people talk as though this is a once-a-century event, but in fact, we've had several pandemics. There was a pandemic in 1968. There was the SARS outbreak. There's one in 2003, one in 2005.
Yeah.
About 12 years ago, there was a US intelligence report which predicted by 2025 there would be a global pandemic based on outbreaks of a corona-type virus in Southeast Asia, probably in a Chinese wet market. I've got the tape. I've got the page. And so these things are all there, and they're often completely disregarded. So one good question, I think, would be to think about what is it about risk assessment in the markets which has meant that we've been so slow to act on 30 years of evidence on climate, for example, and just as many years of evidence about biodiversity loss. Do you think that we're going to see much more sophistication and responsiveness about risk assessment now?
Yes, so the TCFD is one of those frameworks, which is something that is heavily adopted, endorsed by underwriters. Like one of the biggest endorsers of this is Daniel Clear from HSBC. He's the global sustainability head. He actually has 2 titles. The guy has 9 titles, I think. So he goes into like, this is the thing. So this is HSBC represented, you know, and they constantly emphasize on TCFD. So they're saying that this is actually essentially what TCFD is showing the riskiness of each organization's, you know, allocations, operations, and showing that how if they're investing in, or so if their operations and activities are going towards non-green, that will be there. So the first 2 reports have actually come out now. Like I said, Principles of Responsible Investing, which has 1,800 large organizations signed up to the signatories of the Principles of Responsible Investing. They will make TCFD mandatory in the coming year, within the year. So when they make that mandatory, so all those 1,800 plus signatories will have to start reporting on their green and non-green. So when you map out individual organizations, and then that shows you the riskiness of each organization. So yeah, we're moving towards some really amazing developments. And these few years, it's kind of sad because this 2020 was supposed to be a big year for green bonds and green finance, but COVID has completely, you know, shadowed us. But yeah, these coming years are going to be crucial. If you keep an eye out, there's a lot of stuff that's going to change. And the good thing is that, you know, big central banks and networks of central banks, and you have governments, and all of them are backing it. All of them are, definitely.
Lena, quick question. You talk quite about larger companies and massive industries. How do smaller companies move away from high street banks to sort of green alternatives? So SMEs, how do they access this funding? You know, for example, if they're an ethical coffee shop or something, and they don't want to take a loan from Barclays or HSBC, how do they access this opportunity?
So that's where we're talking about when I was asked about the diversification of instruments. That's what we need. So we have green loans. We need more of those. So we need, and this is something I've actually posed this question to a few people, and yeah, as just regular, for example, we want to only invest so we want to only take up a green loan. We want to only have you know, because when we take up a loan and we want to do some green activity, it has to be green, or whatever our persuasion is. Those products or instruments are not available. So yeah, I mean, that's where the market is lacking. Those are the kind of things that we need more development in. Or even green deposits. Why don't we put our money in a green deposit? Why is my money, I don't know where my money goes to. It's just sitting in a regular bank account, a current account, a green current account. We don't have those. It's just, it comes to us if we go to our banks and we ask for them. I would say that, well, I am a person who cares about my finances and where the bank puts my money. I need a green deposit account. So things like that, yeah, we need to have those instruments.
Thank you.
I can't believe there are no questions.
It's a very interesting area. It's definitely a very interesting area. I would advise you guys to just maybe, it's a lot to absorb and a lot of things. It took me a while. Still, I don't think I'm that adept at understanding many parts of the thing. There's some really technical things, for example, pricing and everything. But it's definitely sort of like a hero or a champion or a good case study, the green bond in the industry for economies to set an example that, well, one of the things I forgot to mention, for example, the OECD set out that they had a 10-year plan where they were going to do 100 billion on green activities. So if you look at last year in October, the Climate Bonds Initiative had 100 billion certified on the books green bonds. So 100 billion in certified green. So climate bond certification is the highest level of green in terms of definition and criteria. So we got, by last year, October, in 10 years, we got 100 billion under the book. So just one organization has mobilized 100 billion under their standard. And obviously with our work, we've done more. But that's the kind of stuff each organization can do. I mean, OECD countries, they have way more power and everything, but over the past 10 years, they still have not met those 100 billion on the books target. So it's amazing the stuff that you can do with green bonds as an instrument, because those are like funding, you know, this is a project and we're funding it, the government is funding it, this and that and that. Those things don't really work. If you use the financial markets, that mobility can come in very quickly and far easily than, you know, develop, just depending on the government to be funding green projects.
You've given us a great overview. It's a super set of slides, and you've given a very clear explanation. One of the things that strikes me about the whole system is that we've got this enormous misallocation of capital, despite knowing what all the risks are and so on. And one of my colleagues, a great expert on green finance, Nick Robbins, who used to be at HSBC and was co-director of the UN inquiry into a sustainable finance system, he always says it's the best of times and the worst of times. It's the best of times in that, you, as you showed in your slides, you've got this exponential rise in green bonds, and there are many other instruments. Mm-hmm. But he said at the same time, you've got enormous frustration that there is so much slowness in many sectors in responding to the need for new forms of action. Yes. Do you think it's going to take moves by governments or by central banks, or do you think there is hope that there will be a lot of system-changing action by pension funds?
If you take this from the investor side of things, the investors are like, we don't have enough green bonds. They keep saying, we have so much money. All the investors, they all say, we have so much money, we just don't know where to put it. From the issuer side of things, is the issuers are like, yeah, we don't know how to get the projects going. Like, oh, we don't know how to. So there's lack of projects, there's lack of understanding of how do we issue green bonds. So we in Climate Bonds are doing, like, we have Green Bond Boot Camp where we're going around different parts of the world, especially the emerging markets, because there's a lot of development need, obviously, in the emerging markets. So we try to help build capacity, uplift them into this whole idea of like, okay, this is how you do a green bond and this is how you issue things and blah, 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 blah. So there's lack of projects and everything. We have our Green Infrastructure Opportunities Report series. It's a very long name. I hate that. I keep telling the lady who does that, please change the name. We call them GIIO. Yeah, that has mapped out quite a few projects around the world that are viable projects for green bonds. So they're there. It's just somebody has to come and do them, and that's why you need to have the government supporting them and backing them and making sure that this organization or that organization is a securitized organization and it can back and issue a green bond and then get the funding from where all the money sits towards where all the money should go and the development should go, and then everybody's happy with their returns and mandates and whatnot. Yeah.
Thank you. And do you think that the demand for more reporting, more disclosure, for example, on carbon emissions in different scopes, is that actually pushing investors to think more about green investment, or is it simply at the moment something, another box to tick?
No, so the investors are the ones who are actually driving all of these disclosures, all of these things. So the investors, before, when it started off, the investor was like, okay, we need to know. So before people were coming in and said it's a green bond, investors were like, no, this is not enough. We need to know the whole framework. We need to know this. So then the issuer comes in and satisfies that. Now the investors, for the past couple of years, actually, it took climate bonds a while to change our standard and integrate these things, but they want impact reporting, and most of them want impact reporting. Impact reporting is like clearly showing the metrics, the savings on the emissions, the social, the positives that are coming out of it, the different kinds of impacts that they're doing in terms of helping biodiversity and things like that. So yes, they do want impact reporting. We in our standard have made impact reporting not mandatory, but we have also made it the way the language, obviously, how in standards, how the language is very important. So the way the language goes in is trying to make it like this is very, very needed, but not essential, basically. So we have done that, and then it is definitely driven by the investor. It's their money, and they need to know the disclosure requirements and the impacts and the actual positives that are coming out of it, which is one of the things that is not common. So with the green bonds, when I say it's a quality product, because it's got all these other, so it's just like, when you buy, for example, one piece of clothing over the other piece of clothing, and you say, well, why is this one better? Well, because it's made out of this fabric and it's sustainable and it's this and this and this. It's the same way they look at it. They're like, okay, we're buying into the green bond. We don't really care much about they care about the value of their portfolio that they're going to define.
Lena, are you gathering the data? So if you've got $100 billion of green bonds and you've got 12 clients, are you aggregating that impact analysis into one dashboard to go, if we can fund at this level, this is the impact that we'll get? So you can start to see that positive at an aggregated level.
No, so our organization is not recording the impact or the impact that has been achieved. It's definitely an area of heavy scrutiny, and all the investor community wants to know. Well, we've done, for example, 100 billion under certified, and we've done 258 billion last year. What's the impact of this on, like, quantitatively, can we see a report on this? That's an area of, obviously, different metrics, different kinds of things that are coming out of it. But yes, that is something I think we should definitely be going into, doing research and finding those and mining those things. It could be a PhD opportunity for one of you or a bunch of you.
Or
but
for you.
or for me, definitely. But that, yeah. So it's an area that has to be. I'm sure there are reports out there that do counting of this, but to my knowledge, we don't do these things at the moment. But we should be. We should be. Once our new standard is going to be the only one available after 30th of June, which has impact reporting, I think we should start tracking them.
But I think the principal idea, which is to use green bonds as a way to channel investment and funding into projects that you would like to to promote, has two benefits. One of them, it takes money away from stuff you don't want to invest in, and then secondly, it raises capital for those projects and individuals you would like to support. That's fine. The odd thing about this is that you in climate bonds, you're working in the extremely large business. I mean, that's typically public sector public sector organizations, countries, or organizations that are so large they might as well have those bonds, because they've got public sector backing, like SNCF, for example, you mentioned earlier. I think most of those bonds are then probably also being split up into smaller parts and then into smaller tranches, and then those tranches are then being sold on again, and so on and so on and so on and so on. And what strikes me about this is that there are also a lot of people who would like to invest in those funds. There are ethical investment funds. There are pension funds that offer those things, and under the pension fund regulations, one of the PhD students from CES, Steve Waygood, has made a really interesting career at Aviva to look at the governance of those ethical funds. So we already have a well-established principle of lending with strings attached. What is, in your own words, missing are the number of projects that would follow those strings, a governance system that makes sure that the strings actually are attached and actually are being followed, and yet, at the moment, everybody talks about the dire economic situation, how difficult it will be to get us out of out of the COVID-19 world, out of the lockdown, and the economic problems we have. Why? Have you seen any initiatives from governments to attach strings to the transition out of COVID? Because I mean, the green bonds market looks to me like a really good avenue to channel that in that part as well, adding to the demand for those green bonds.
Yeah. So with the COVID crisis, you had quite a few articles that came up, and Environmental Finance did a really good piece by Peter Cripps. So what they've done is because the COVID crisis was so, it's been such a haste. Every government has been reacting in haste, and obviously they have to get to rescuing everyone from out of this. So it's been like quite a few bonds didn't even go into getting second party opinions or any of those things. They just issued, and people just put money into them. But since the COVID crisis, there have been calls by big governments, especially the European Commission, and a lot of leading authorities in the UK, everywhere in different parts of the world, we're saying that they want to make sure that now that they will have a bailout for post pandemic, they would want that bailout to be completely green, that we do not we do not put this money towards any non-green activities or non-sustainable activities. So there's a huge call for that. The example will be set by EU, I'm assuming, and also by Chinese authorities. But yeah, there's definitely, even in the UK, there's a call for this, when the pandemic is over, that we would want to start the economy back, and there's huge funds that will be flowing into the economy to get it started, that all of this should be sustainable. So there are voices, and this is where CBI is standing up as well. We need to be a lot louder. We've realized in CBI, because we've kind of gone away from the talk of the transition, because this year we were supposed to dominate that space, and this COVID crisis has kind of like tipped us away. But yeah, that's one place where literally me and my boss have to like start doing more things, and with the CEO and everyone on board.
Lena, can I ask you, where is China in this? Are they a competitor, a collaborator, or are they ahead of us? Where's China in this?
So when you look at China is quite, in terms of government policy, China is quite good. China is very, very aware of the sustainable transition. They are very keen on reducing, because in China, for example, you have huge problems for air quality. Their air quality is pretty bad in cities, and people have actually suffered heavily from that. So China, in terms of adoption of the EU taxonomy, they're already working on that. So they're translating the EU taxonomy into, and CBI is actually working with Chinese authorities on this. So they're developing a Chinese taxonomy as well. Now, issuance from China is, if you look at country by country, it's always been second or third. So US always ranks first. If you break EU down, if you look at EU, then EU is always first. If you take EU as a whole, but if you break them down into countries, US is first and China is always second in terms of green bond issuance. So it's the second largest green bond market, but they don't really issue. They issue a lot of local currency bonds. They don't issue a lot outside of China. So other currency bonds, they issue a lot in renminbi. So yeah, China is leading the way, actually. China is quite good at definitions, and they're using the same model as the CBI model, though they don't certify much with us, which is kind of bad because we don't make money. But they do have, they're following the same model of verification and things. So EU is going to follow the same thing, which is the model of like you make a framework, you engage the verifier, you do a pre-issuance report, then you issue the bond, then you do a post-issuance report, and then you continue reporting. That model is the Climate Bonds Initiative model, which is the same being followed in China. It's being followed by the EU. It will be followed by the proposed EU Green Bond Standard. So yeah, so China's quite good.
Lena, when you go into the next level of detail, so if they're following this model that you've just sort of explained as like a process, are countries adopting the sort of same standard? So if it's reduction of something by 10% or whatever, are they following the same methodology and metric and measurement? So we're creating some level of consistency, or are we going to find ourselves in a position that one country is measuring it in one way, another country is measuring it in another way, and then it's very difficult to aggregate back up to see the impact totally?
Yeah, so if you go from sector to sector, some sectors are pretty, like for example, the shipping sector. The shipping sector is pretty much, harmonized. It's got the same kind of metrics. But if you go to buildings, there's buildings, every country has because of the grid of each country, depending on the kind of benchmarks you have, the kind of, bulbs or whatever standards that they have, or things like that. So emissions will be different from country to country. So the Climate Bonds buildings, low carbon buildings criteria goes from region to region, city to city. So for example, if you're, what we say is it has to, for example, London, it has to have the 15% of the top, it has to follow the emissions that are being followed by the top 15% of the buildings, sustainable buildings or green buildings in the city. So we take a sample of the top 15%, and then we say, okay, this is the highest that they've achieved. with a trajectory in place of year-on-year reductions to net zero by 2050. So they have to be every year checked on the trajectory. So the longer the duration of the bond till 2050 will be like a less steep trajectory, but if it's like a shorter bond, so they have to have a very, very steep reductions in emissions every year. So that's how they maintain their buildings certification. Though buildings is like, I think, so energy, which is solar, marine renewables, blah, blah. So the energy, buildings, and then transport, low carbon transport, are the highest certified number of bonds that are certified are in these three sectors. So it depends on where you are, and depending on what sector. It's very complex, because I did the research on cement. It's so complex. Cement is essentially going to be brown, always going to have high emissions. There's no way, as the production of cement is not going to be zero carbon at all, unless you put CS in there. But yeah, so it depends on sectors.
Thank you.
Yeah, so many things. My interest in this, I think, is both personal, but also academic. On the personal side, I'd love to find ways to invest my mortgage into those bonds. And I think Barclays offers green loans on that one. I need to figure those ones out. But there's also the question of where the bottlenecks are. Because at the moment, it seems to be that the bottleneck isn't necessarily in people wanting to raise cash in green bonds. The bottleneck seems to be in the lack of projects that are verifiable enough and performing enough to be eligible to be subjected to the green bond governance treatment. So the issue is not on raising capital. The issue is not on spending capital. The issue is on the individual projects that are not coming across. And within that, I think there's also the issue of the US. I mean, I was very, very surprised that you said the US is always first. Under Donald Trump, I can see a great diversion away from green or ethical or SRI investments, and then more a movement towards stuff that brings jobs, whether that's in the coal industry or the steel industry or God knows where. So, two questions really. Can you see ways in which that bottleneck can be overcome? And secondly, how long do you think Trump will make sure that the US will not be first in the development of green bonds?
Well, thank God for free markets, right? So that has been the reason. Capital, raising capital is, we're talking about, free markets who are actually issuing. So Fannie Mae, for example, is the largest issuer, I think, in the world for green bonds. The number of green bonds they've issued, no one can match. And that's probably one of the reasons why US tops the rankings each year. But US is the largest capital, I think, market in the world. And we in CBI, we're not that, because of the fact that Trump and everything is just a bit where we, for example, engage with policymakers and all those things. So that's where the bottleneck, one of them, is the policymakers to be able to, for example, to work in Brazil with this new government. When this new government came in, it was very hard because we were working with the old government, and then the new government comes in and everything is just flipped. So in emerging markets, you need to work with governments very closely because they are the ones who have more power over the financial markets, the regulators and the policymakers. So the bottleneck is there. The bottleneck is obviously that thing, the red tape, the bureaucracy, the political side of things. Not everyone is on board. Why sustain, in CBI, we prefer the EU because the EU, the European Commission, is one huge body which makes a lot of these very big decisions. And you just have to talk to that one body rather than individual countries. Because when you talk to individual countries, it becomes way more slower. So sustainability likes organizations such as, also same in China, where Chinese government will just make the decisions on their own. So these type of things where certain types of structures, bureaucratic structures, are sort of like causing a bit of slow reaction. And then the other bottleneck was the fact that, yes, you have lack of capacity or understanding in the market of how do we do this, lack of understanding of the different criteria and the standards. And that's one of the things where with climate bonds, we just want to make it as, like one of the guys who actually has written the standard, he's like, I just want to make it a checklist. Like it's literally like tick, 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 and there we go, and you have a green bond. It should be that easy. So make it so easy for the markets that they just like, it's a checklist, basically. And so that is the goal. That is the idea with climate bonds work, is just to make it super easy for the people to come on board, and to make sure that the willpower and the will is there at the government level, the regulator level, the market level, where you have, you know, stock exchanges and all, you know, central banks, everyone supporting this. It's like a tiered approach, and those are the issues that you need to deal with to grow this market to higher issuance.
Excellent, wonderful. I've got a keen and nervous eye on the time, and we are getting close to having to conclude this. Are there any other questions that people have, apart from the 15,000 that I'm sure Chris and I and Ian and Gordon and Latif might also have? No? Wonderful, excellent. Wow, I mean that's a lot better than what I normally have when I'm giving a lecture, and then people go, well, here's 75,000 questions because you really have not explained this in the way I wanted you to.
Thank you, Lena. That was fantastic. Really good.
Absolutely, yes.
If everybody wants a few more links to sources on green finance, such as the principles on responsible investment from the UN and so on, I've got a list of links which you might want to follow up at the end of the lecture slides.
Yes, please.
Yes,
Are
please.
we going to be covering sort of, I know we've got a slot tomorrow about AI and technology and IT and sustainability. Will we be backtracking to this a little bit and seeing how those technologies could simplify the process and create more reporting and more understanding of the impact that it's actually having? Is that being covered?
That's a great idea, Lisa. So hold on to that thought and make sure you raise it tomorrow.
I think James was also making the case for blockchain technology, which is part of the verification, which is one of the verification
and also,
options.
you guys could investigate this case study about eBay. eBay rewrote their source code, and they did 95% savings in that, just to rewrite their source code for the first time. They did this is the first time in their establishment that they've actually rewritten their source code, and they brought such huge efficiencies in using energy, 95% efficiency.
Wow.
Impressive.
Yeah.
That's a good case study. Thank you, Lena.
That helps a lot. Wonderful. I'm sure in the next couple of days we're going to come back to some of the issues, and I'm sure I will not refrain myself from emailing you some of those questions, Lena. So be prepared for some nosy additional questions.
No, 100%. We do.
But you've been an absolute star. And thank you very, very much for that one. Absolutely.
Thank you, everyone. This was such a good experience. Thank you so much.
Thank you, Lena.
Good, thank you.
Good luck.
Cool.
Bye.
Good.
Bye-bye.
And that leaves me about a minute to summarize this. Yeah. Should I do speed talking, or should I just use the example of a stone flipping over water and just suddenly touch a little bit on the broad trajectory? I think it helps very much also in the discussion about systems, because the whole discussion we have on ISO 40001 and then SR 26000 and so on and so on, and all the acronyms that I've hopefully unsuccessfully bored you to pieces in the lecture, is about having a governance framework for specific activities. Whether this is on energy or risk or management overall or quality and so on and so on. And then that governance framework, I think, is the bread and butter of Lena's business. That's the way, and I think it's interesting that the European Union has come up with a framework that also is by design externally verified. So the question then is like with the management systems, if it's quite simple and straightforward to have these systems enabled, they should really be used much more. In the meantime, I've had a look at some of the green bond funds that even individuals can buy. There's one from AXA that I think repackages a portfolio of individual bonds. And then the performance of that one, I think, is about 25% better than that of the bond market. So I'm thinking, well, as an individual investor, this is not just on the ethical side the right thing to do, but is also on the economic side safer and better. So happy days. Whether this is going to lead towards more sustainable practices, I think that's the rest of the course we're going to have and we're going to struggle with. So yeah, I hope you enjoyed it. I hope this was useful, and thank you very, very much. I think we're going to see each other again tomorrow morning, 9:30.
Mm-hmm. Good to see everyone. Thank you for those contributions.
Excellent. Wonderful.
Thank you.
Good afternoon.
Have a good evening.
Okay.
Ciao.
Bye-bye. Bye-bye.
Take care.
Bye.